Gold is at 4,348, down roughly 10% from its conflict-era peak, up 46% year over year, and it is holding while a naval blockade is active, yields are surging, and the Fed is not cutting. Sit with that. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Treasury yields just broke 4.30%. Brent crude is above $110. The Strait of Hormuz is blocked, and gold has not broken down. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. The Strait of Hormuz blockade. The United States activated a naval blockade in the Strait of Hormuz. That single event sent metals lower on surging inflation concerns. Then gold rebounded to $4,761 per ounce on Tuesday, April 14th. It did not collapse. It recovered. The March CPI print showed a 0.9% monthly jump, the highest single-month reading since mid-2022. Brent crude pushed above $110 per barrel following the Strait closure. The 10-year Treasury yield surged to 4.39% in recent sessions. That is not a minor move. That is a forced repricing of Federal Reserve expectations. The timing is what deserves scrutiny, not the event itself. The timing. A blockade activates, inflation spikes, yields surge, and the Fed, already holding the Fed funds rate at 3.50% to 3.75%, gets locked into a higher-for-longer posture. Think about what that sequence actually means. The war premium and the inflation headwind are now running in opposite directions. That contradiction is the entire story. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. Gold is down 10% from its peak, while a naval blockade is active, and a failed diplomatic process with Iran has removed the resolution scenario entirely. The last time real yields were this high with geopolitical tension, this elevated gold found a floor, not a floor break. The data is already telling you something. Let's build it out. Now let's build the full picture, because the Strait of Hormuz blockade does not exist in a vacuum. The Federal Reserve, per its most recent public statements tracked by Financial Content, has adopted an explicit higher-for-longer posture. The Fed funds rate sits at 3.50% to 3.75%. Investors who had priced in multiple rate cuts in 2025 have been forced to liquidate those positions. That liquidation is compressing gold's ceiling, not breaking its floor. Trading Economics confirms central bank gold purchases slowed in January 2026 to just 5 tons. Compare that to the monthly average of 27 tons throughout 2025. That is an 81% month-over-month drop in central bank accumulation. And yet, Malaysia and South Korea have resumed reserve accumulation. China has continued increasing its reserves. The demand has not disappeared. It has redistributed. The DXY sits at 98.40, sub 99. A weaker dollar makes dollar-denominated gold cheaper in foreign currency terms. European and Asian buyers are getting relative discounts at current dollar levels. That dollar weakness is partially offsetting the yield headwind in real time. The rate of institutional pressure is not uniform. It is compressing from one side while structural demand holds the other. The data is doing the talking. The ones who said central bank demand was the structural floor, they are not being challenged right now. And here is what makes that picture even harder to ignore. Gold's open interest in the futures market is being actively monitored for signs of institutional unwinding. The failed Iran talks have removed the near-term diplomatic resolution scenario. That matters structurally. At the same time, the inflation channel created by the Hormuz closure is pushing yields higher, which compresses gold's real return versus treasuries. That is the contradiction at the center of this setup. That is not noise. That is the setup. The honest caveat, and this matters, setups like this can take a long time to resolve. The structural picture can be correct, And the timing can still punish you. Anyone who claims to know when this resolves is selling something. What the data shows is the tension. The structural floor near $4,600 to $4,650 is supported by central bank buying, dollar weakness, and geopolitical premium. What the data does not show is when the paper market fully prices the physical reality. Those are two different questions. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about right now: 21 million barrels per day. That is the volume of global oil supply that transits the Strait of Hormuz daily. If that strait stays closed, every energy-dependent economy reprices. Every inflation model gets revised upward. Every central bank rate path gets pushed higher. And gold sits at the intersection of all of it. Now the macro variable, because this is no longer a backdrop, it is the primary variable. The US-Iran talks have failed. There is no diplomatic resolution on the table currently. The US naval blockade is active. Brent crude is trading above $110 per barrel as a direct consequence of the strait closure, per trading economics data. The Federal Reserve is now caught. It cannot cut rates into a 0.9% monthly CPI print. It cannot ignore an energy-driven inflation shock without credibility damage. The market was pricing multiple rate cuts in 2025. That pricing is being unwound in real time. Markets are still pricing a partial reopening scenario into energy futures. Look at Brent above $110 and tell me what probability you put on a rapid resolution. When markets start pricing the reality of a sustained strait closure, gold's war premium reasserts. The yield headwind does not disappear, but the haven demand reaccelerates. Every time a major energy choke point has been blocked, commodities, currencies, and metals have all repriced simultaneously. It has not been different yet. Gold Western Spot at 4,648, the DXY at 98.40. The 10-year yield between 4.29% and 4.31%. That is the exact data environment as of Tuesday, April 14th. The short-term picture is genuinely contested. The $4,600 to $4,650 range represents the structural floor, supported by central bank buying redistribution, dollar sub-99, and geopolitical premium from the active blockade. The upside scenario toward $5,000 requires sustained strait closure, continued central bank buying, dollar weakness below 97, and any signal of Fed pivot. The downside scenario to $4,300 to $4,400 requires a diplomatic resolution reopening the strait, energy prices collapsing, risk assets rallying, and haven flows reversing. If the 10-year yield breaks back above 4.40%, that adds meaningful downside pressure in the near term. If dollar weakness extends below 97, that partially neutralizes the yield headwind. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold does tomorrow. Nobody can. If you think you know, good for you. The current environment has three major variables moving simultaneously: yields, dollar, and geopolitical resolution probability. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. First, the 10-year yield at 4.30% to 4.39% raises the opportunity cost of holding non-yielding gold directly. Second, a diplomatic resolution reopening the strait would collapse the energy inflation channel and allow risk assets to rally at gold's expense. Third, central bank purchases slowed to 5 tons in January 2026 versus a 27-ton monthly average in 2025, removing a major demand accelerant. The bull case is equally real. First, the DXY at 98.40 provides a structural currency tailwind for non-US buyers, supporting demand from Europe and Asia at current levels. Second, Malaysia and South Korea resuming reserve accumulation signals the central bank bid is diversifying geographically, not disappearing. Third, the failed Iran talks and active U.S. naval blockade have removed the near-term resolution scenario entirely, sustaining the geopolitical premium. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything I showed you today points to one thing. Gold at $4,648 is not a weak number given the yield environment it is holding against. The structural pressure is already built. The only question is when the paper market catches up to what the physical market already knows. Don't take my word for it. Verify every number I gave you today. Check the data yourself. Trading Economics at tradingeconomics.com. Financial content at financialcontent.com. The U.S. Federal Reserve at federalreserve.gov. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.